Intel has been one of the more disappointing stocks in the market over the last 1 year, 5-year, and 10-year periods. That's unfortunate for me because I recommended Intel as a buy in 2024. It's been one of my worst performing investment recommendations. That being said, how much is Intel stock really worth when you do a discounted cash flow valuation and come up with the intrinsic value? That's the question I'm going to answer in this video, utilizing the discounted cash flow valuation method. Now, I'm going to use several assumptions and estimates, as you always have to do when you're trying to predict a stock price value with imprecise information. And so I'll share with you precisely where I'm getting all of these numbers and where I'm making adjustments so that you can see for yourself and determine if these changes, adjustments, estimates, assumptions, if they're accurate, if they're too optimistic or too pessimistic. All of that you can decide for yourself because you'll see where I'm getting the numbers from, where I'm deriving the information from, and you can make your own judgments. Okay, with that being said, let's get into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so let's start gathering our information we're going to use for this stock price estimate. All right, so let's start with the current market price, $22.76 per share. The free cash flow for Intel, negative $12.58 billion in the most recent update. And that's because of the heavy investments Intel has been making in expanding its manufacturing footprint, expanding research and development, capitalizing on government incentives to build out manufacturing in the United States. All of that, Intel might be getting ahead of itself with these investments. It's turned its free cash flow negative. Now, I'm going to make an adjustment to this free cash flow. As you can see here, prior to these massive investments in 2022, Intel was generating over 12 billion, close to 20 billion in free cash flow. So what number do we use? We can't use this negative number. This is not indicative of the company's prospects in the longer term. Can't use this 20 billion number because that's too high. This is before NVIDIA started taking market share away from Intel in the data center space. So the number I chose to use is 6 billion. And then we can decide whether or not the 6 billion free cash flow number, too high, too low. You can decide for yourself. You can see Intel's historical free cash flow. You can see Intel's billions of investments in the factories. And you can see in the future slides I'm going to share with you what Wall Street thinks about Intel over the next 5 years. All right, I also need Intel's shares outstanding, 4.212 billion shares outstanding. Intel's long-term debt of 53 billion, Intel's market capitalization of 97 billion, and finally Intel's cash and equivalents of 11.29 billion. To forecast a growth rate, I'm going to use the 5-year estimate from Wall Street. The Wall Street analysts that are following Intel stock, they expect it will increase the earnings per share at 15.69% over the next 5 years. That's the short-run growth rate I'm going to use for Intel's growth in free cash flow over the next 5 years before transitioning into a slower growth rate in the longer term. All right, so now that we have all of our inputs that we're going to use in our discounted cash flow valuation, we can go ahead and start making the calculations. Let me draw your attention first to this free cash flows cell for 2024 of 6 billion. I highlighted earlier that that's an adjustment I made looking at Intel's previous historical free cash flows annually and looking at the current negative free cash flows and making an adjustment that suggests the company can return to half its free cash flow of the previous decade peak, 6 billion, okay? Now, you might think that's too low. Some might think that's too high. Some might think it's right on point. And at the end of the video, I'll change and play with this number and see the different valuation numbers we get as I change that free cash flow estimate for Intel's performance. Now, if we start with this 6 billion and we apply that 15.69% short-run growth rate for the next 5 years, we get an estimate for Intel's free cash flows. And then after the 5th year, I have Intel's growth rate slowing down from 15.69% to half that rate. So just 50% of that 15.69, and that settles its growth rate down to 7.85% for the next 5 years between 2030 and 2034. And then I have the company settling down to an even slower growth rate of 4% for the very long run. All right, so these are the estimates for its free cash flows over the next 11 years. However, since these are cash flows expected in the future, we have to discount them because money in the future is worth less to us than money today. We'd all rather have money in our pocket today instead of money in our pocket 5 years from now. So I applied the discount rate of 8.81% for Intel with its cost of debt at 7.5% and the cost of equity at 10.12%. I have its market debt and equity cap weights at equal 50-50, even though right now it has total debt of $53 billion and a market cap of $97 billion. So its total debt is larger than 50% of the market cap. It's most accurate to identify the target capital weights for a business, not the current capital weight, because in the short term, companies' capital structure deviates from what they desire to have, right? In the short term, they might opportunistically capitalize on lower interest rates for financing, and so they might take on more debt. But then when interest rates increase, they'll rebalance and get a more targeted capital structure. So in the long run, companies gravitate toward their long-run capital structure, while in the short term, they capitalize on opportunities with either a very high stock price, they'll sell more equity, or very low interest rates, they'll take on more debt. So for that reason, I sometimes adjust. And with Intel, I don't think they desire to have this much debt. Their short-term debt right now is higher than they would like it to be. So I estimate that their debt to capital, their debt to market equity will decrease. And the adjustment I'm making is slight to 50-50. And so that gives me the weighted average cost of capital of 8.81%. So if I take the present value of all of Intel's free cash flows estimated over the next 10 years, I get a value of $75.88 billion. Then, instead of forecasting Intel's free cash flows from 2034 to infinity, we can use a method called terminal value calculation, where we collect all of those expected free cash flows between the year 2035 and infinity, and we can collect the terminal value at this point in time. To make this calculation, you need the free cash flow estimate 1 year ahead, divided by the company's weighted average cost of capital minus the growth rate. And that gives me the terminal value of Intel future cash flows at $392 billion at the year 2034. But I'm not done yet. I need to get the present value of that free cash flow all the way back to today, and that gives me $168 billion. So when I collect the present value of cash flows and the present value of the horizon value, that gives me a value of operations for Intel at $244 billion. All right, so now let me draw your attention to this middle part here, where I have the value of operations. Then I need to add the company's cash balance and subtract the debt. When I add the cash balance of $11.29 billion and subtract the debt of $53 billion, it gives me a market value of equity of $202.763 billion. Then I need to divide that with the total number of shares outstanding at 4.212 billion to get me an intrinsic value per share of $48.14 for Intel stock. Now, compared with the current market price of $22.76, that would suggest that Intel stock is undervalued using these estimates and assumptions I've used in this video. Now, I've had Intel stock rated as a buy all year long, as I've suggested, so my research has indicated that Intel stock is undervalued. Still, the stock price has underperformed significantly in 2024. So that goes to show that our estimates and assumptions don't always work out to drive investor returns. Now, I told you I would play with this free cash flow estimate to see how it changes the valuation. So I assumed the $6 billion free cash flow for Intel at a steady state. But what if I assumed $4 billion? How would that change the valuation? Well, that would bring it back down to $28 per share, which would still be above the current market price. What if I estimated at $3 billion? And that would bring it down to $19 per share. What about at $3.5 billion? That would raise it up to $23.96 per share, which is very close to where we're at now. So it seems like the market, if we're using these assumptions and estimates for everything else, it seems like the free cash flow estimate for Intel might be $3.5 billion. And that's if you're holding everything else constant. Now, I could have held the free cash flow constant and changed everything else, and that would have derived different estimates for what the market thinks Intel is going to deliver in terms of long-run growth rate, short-run growth rate, etc., different weighted average cost of capital. Now, this should be just for entertainment purposes only, and it should be one tool you use in your overall analysis of Intel stock before making a decision. I encourage everyone to conduct their own due diligence before deciding on making any investment decisions. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.